please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But right now it's time for our special segment, Hunting for Value, and Mangalam has a metal stock on his radar today.
Absolutely. So after a stellar rally of nearly 185% between 2016 and 2017, Tata Steel, that one's corrected about 20% in 2018 so far, lost about a quarter of its market cap from its 52-week high levels of close to 750 rupees. Now, the street believes there are these reasons for the fall. Opposition by ThyssenKrupp employee union to a joint venture with Tata's European business, fears that Tata Steel may make revisions to this joint venture deal, and the negative sentiment on the metal stocks owing to a possible trade disruption due to global tariff wars are the key reasons for this fall. And that recent rally in the dollar index all the way from 90 to 95 didn't do too well for the metals across the world either. Remember, Tata Steel's European business has been an overhang on the company, with nearly 62% of the company's liabilities and only 16.5% of its earnings before interest and tax. And remember, the company's consolidated debt to equity of 1.5 times will rise with the new acquisitions via the IBC, pressuring their balance sheet in the near term. This perhaps explains the falls, but there are quite a few possible triggers for reversal. The first one, of course, is the speedy resolution of ThyssenKrupp joint venture without any big adjustments. That is something the street would like. Benefits of Bhushan Steel acquisition becoming visible, and winning this bid for Bhushan Power and Steel will benefit the company on account of lower expansion costs as well as time savings. The consolidation in the sector as a whole as a result of this would lead to better pricing, and there is a strong demand cycle despite the tariff wars that are taking place, and any clarity on the debt management plan as well as future of the European business will be taken well by the street. Brokerages by and large positive on Tata Steel. There you have it. Nearly 23 of the brokerages that we have are either a buy or an outperform rating on the stock, as against 4 which are either hold or just 1 underperform. So some brokerage calls should come up for you on your screen. We have Jefferies with a hold rating, 584 rupees target price. We have Edelweiss buy on the stock with a target price of 903, as well as Kotak recommends another add on Tata Steel with a 12-month price target of 710 rupees. Valuation wise, the stock does trade at a discount to its peers, so about 7.5 times FY19 price to earnings, 7 times FY20 price to earnings. So with these triggers in place as well as the reasons for the fall, it will be very interesting to see how the street treats this recent correction in Tata Steel's stock price. Is there value, or after a stellar rally in the last 2 years, all the positives are priced in? That is something only time will tell. But before I wrap, a quick disclaimer: this is not a stock recommendation for buy or sell, just some research that I've put out.
Okay, all right, Mangalam, thanks very much. Yes, we take that on board. This is definitely not a stock recommendation, but let's carry the conversation forward, the debate forward, whether Tata Steel deserves to see some sort of a rebound right now, whether it's worth an investment. We have with us Amit Dixit, who looks at this company. He's from Edelweiss. Amit, morning. Thanks for joining in. So as Mangalam was highlighting, there are a couple of near-term concerns, right? There's, of course, this whole tariff talk issue, which could perhaps, sort of turn the sentiment against it. There's rising Chinese supply. And, of course, the biggest perhaps fear of them all, what if the deal with ThyssenKrupp goes off the table? Which of these 2 or 3 factors do you think is a real threat for you?
Yeah, good morning. So Tata Steel, recently, as has been highlighted, it has struggled a bit because of 3 factors. One is, of course, the whole ThyssenKrupp thing and the concerns of it falling apart. The second thing is, of course, the deleveraging front. On deleveraging front, the Tata Steel's endeavor, has been quite undermined by the fact that there are too many moving parts, like acquisition of Bhushan Power and Steel. Add to it the fact that the street was expecting that there would be some respite from debt post ThyssenKrupp deal. Now, a probability of it not happening or not happening in the way it was initially envisaged has been negative for the stock. And add to it the fact the macro concerns such as rising dollar index and of course the global tariff wars. All in all, I believe that these are certain certain short-term or medium-term concerns that have kept the stock quite subdued in terms of performance. If you compare it with the peers such as JSW Steel in terms of stock performance. But in long term, we do believe that in India there is going to be a ample scope, ample headroom for the larger players to become even larger. And particularly Tata Steel's Bhushan Steel's acquisition, I believe it will be value accretive. The reason being the auto grade steel, which is like, selling like hotcake at the moment, and you have add to it the fact that this particular kind of steel commands a premium over the regular steel in the market. So that is one thing. Then any resolution on ThyssenKrupp, which is expected by end of this month or later, would be kind of perceived in a very positive manner if Tata Steel doesn't have to give away too much. On valuation, I would say that the stock is quite reasonably valued as compared to its domestic peers as well as global peers. But word of caution over here is that, you know, in the short term, the macro concerns are playing a major role and are keep the valuation subdued. See, there is absolutely no concern on the earnings at the moment. The earnings would hold good, earnings would increase, but you know, it is like very much the situation in FY14 when the steel companies actually showed an increase in earnings. But the valuations remained subdued. So this is the kind of, you know, dichotomy unfortunately we are struggling with. But at this price, I believe Tata Steel definitely deserves a look.
Okay, Tata Steel deserves a look. Your target price is what, 903 on Tata Steel?
Yes, it is.
Okay.
Yeah.
All right, so that's a significant upside because the stock is quoting at what, 560 from here on. But given the near-term or the medium-term macro pressures that you alluded to, the concern about debt because they will go ahead and acquire Bhushan Steel, plus there is a possibility of the ThyssenKrupp deal getting revised, which may perhaps take less debt away from Tata Steel. But in the medium to near-term, do you see the stock headed lower?
Well, I would see that I would consider it this way, that even if you consider all these negatives like even ThyssenKrupp, and of course the street has got a different kind of, you know, assumptions based on the kind of debt that Tata Steel would be able to park in joint venture. So I believe, as I have been maintaining this, that the street has taken into the fact the cost part of it, and of course the worst element of it. I mean the kind of worst possible assumptions, the most conservative assumptions, I believe. But the upside that comes from any any relief on this front, ThyssenKrupp or, you know, Bhushan for that matter, Bhushan Power and Steel. So, you know, these are the certain concerns that have kind of pulled that stock down. Answering your question directly, I don't believe that the stock is headed quite low from these levels, because I believe that at this price the concerns are mostly priced in.
Okay, all right, Amit, we'll leave it on that note then. Thanks very much for joining in. That's a positive call from Edelweiss on Tata Steel. Speaking of Tata Steel, let's broaden it out to the rest of the commodity universe and find out how things are shaping up there. We have Manisha Gupta joining in. Manisha, we're still eyeing those crude prices very carefully.
Oh, well, yes, doesn't end there really, because after the meeting, even as the meeting has ended, we still are awaiting a lot of finer details here on how much is the exact increase in the supplies and how much will each member produce. Because remember, many of these OPEC members really have no capacity on the higher side to produce more, and Saudi Arabia cannot take it out on itself to produce higher, because that would really be a backlash for that country. So there are still a lot of ifs and buts which the markets are awaiting right now. So after nearly 5% gains on Friday, which was a knee-jerk reaction, you have seen some profit taking come in for the crude oil prices on your screens. As and when the data starts trickling in, markets do make sense of the demand and supply numbers on who is producing how much, is when we will see all of that come into the prices. But most international experts do tell you that we have seen bottom come in place for the crude oil prices, and from here on it is consolidation or even further gains for the rest of this summer season in the international markets. The gold and silver prices in the meanwhile also saw some strength come back. This is because the US dollar is off its 11-month highs. There also are now trade concerns brewing between US and Europe, and that in turn has led to some safe haven buying. So 30,600 is back in case of the gold prices. Silver hasn't been able to gain so much because it's getting much of its cues from the metal space, which again has been quite divided in sense of reaction. In metals, you have copper and aluminum prices taking some strength. That is because the strength in steel prices seems to be transferring here. But when you look at the other metals, whether it's nickel, zinc, or even iron ore prices, all of that have started the day on a weaker note. Markets, of course, are taking stronger cues from the fact that China is has actually announced the bank reserve ratio as on the lower side. So that means more liquidity that perhaps will prompt more demand for metals in China. But all of that is yet to sink in, and the initial reaction isn't so great. Zinc especially has declined quite a bit. We are trading at around 8-month lows onto that one. But that's because the inventories on Shanghai and LME, both these areas, has been increasing onto that one. It really is about individual metals as we see some strength and some in the weakness, or mixed trend is what we are seeing here. Trading strategies is what we have from Anand Rathi. They have a buy call on all commodities for the beginning of this week. In case of gold prices, they're looking at an upside of 30,700. They also have a buy call coming in for the crude oil prices. 4,700 is what they're targeting there. And for copper as well, it continues as a buy call. 459 rupees per kg is what they're looking as and an upside.
All right, Manisha, thank you very much for that. Time for a short break. On that note, on the other side, P.N. Vasudevan, the MD and CEO of Equitas Small Finance Bank, will join us next to help us understand if the turnaround in performance can continue into FY19. Welcome back. Tata Motors is actually driving in reverse gear today, so now down close to about 3% Tata Motors DVR2 under significant pressure, while at the investor meet on Friday, JLR has guided for an improvement in margins. They did sound cautious on the demand outlook. They cited headwinds coming in from diesel uncertainty, Brexit, a weak demand cycle in the West on the back of increasing concessions that they have to give. So a bit cautious on demand, and that apart, the company's investment plans, its aggressive investment plans and capex will put pressure on its cash flow. So these factors could be weighing in on Tata Motors, and plus even its counterparts globally like Daimler, BMW have seen their valuation multiples contract and being under pressure. So Tata Motors is under severe stress in today's trade. But let's turn our attention to Equitas. That stock has lost nearly 10% in the last 1 month. Let's find out about their FY19 outlook with Mr. P.N. Vasudevan, the CEO and MD. Good morning and thanks so much for joining in, sir. We've seen the 10-year yields rise quite a bit for the Indian markets. What is your own outlook? What will be the expected increase in cost of borrowing? Do you see your margins being under pressure? Can it be passed on?
Good morning. So in the last 2-3 months, we have seen liquidity tightening and the interest rates going up. And the general expectation is that the interest rates will continue to be at a reasonably elevated level over the next few quarters. So we have also raised our deposit rates. So we have raised our deposit rates by anywhere between 50 to 75 basis points based on various tenors. But given the kind of segment that we lend to,
Okay, I think we just lost that line with Mr. Vasudevan. We will try and connect with him. He's making an important point. So Equitas has already raised the lending rates by about 40 to 75 basis points. That's quite interesting because it's not a small increase. And looking at the segment they target, I'm guessing they think they do have the pricing power to carry out that kind of a price increase. We'll try and just get back in touch with him in a moment. Okay, in fact, Mr. Vasudevan, we do have you back, sir. Please go on. You were telling us about this lending rate increase that you've undertaken, 40 to 75 basis points. So you feel that this is not going to impact demand adversely in the segments where you lend?
Did you still have to write off more MFI loans as you did in the Jan to March quarter?
yes, so in the October-December quarter of last year, we had written off the made a full provision for the MFI impacted portfolio, which was basically the old portfolio which was there at the time of the demonetization in 2016. But all the loans that we have given post the demonetization starting from January 17 onwards, that performance has been absolutely good. And the NPA levels are very normal, back to the normal levels of what typically is an NPA in microfinance, which is around 0.5 to 0.7%. So we have not seen any change in that so far. And the NPA, GNPA as of March 18 was 2.72%. And we believe that the GNPA will remain very steady over this year, because we are seeing collections to be very robust, whether it is microfinance book, which is about 27% of our total portfolio now, or the non-microfinance book, which is a balance 73%. Our collection continues to be very strong and robust. So we expect that the NPA should more or less remain steady for this current year.
Some more parameters, Mr. Vasudevan, that will help us figure out the, the profitability and the trajectory going forward. CASA, as as a percentage of your borrowings, where does that number stand? The cost to income ratio had improved in the fourth quarter. I think it was at 77%. How much further can you improve it over the next 1 or 2 quarters?
Yeah, our CASA was about 35% as of March 18. Our total deposit was around 4,800 crores, which was about 45% of our total borrowings. And out of that deposit, around a third of it was in CASA, which I think is a reasonably good performance. In terms of our cost to income, see, Equitas Bank model is a high cost model. Fundamentally, it's a high cost model. Basically, because we are lending to very small people, the ticket sizes are very small, the financial documents are not very clear, so we do a lot of field-based assessment. So our model is definitely a high cost model, and because of that, our cost to income always will be on a slightly higher side. Of course, we'll have higher NIM to compensate for that. Typically, instead of a 4% NIM of traditional banks, we'll have 8% plus NIM, but our operating cost will remain elevated. Last quarter, it was 77% cost to income, and this year we estimate that our cost to income by the end of the current financial year should somewhere stabilize around 70 to 71%. That's what we believe should come this year.
Okay, the auto sales numbers are looking good, and Equitas itself is focusing on vehicle financing as well. So is there upside to your AUM guidance of 35% for FY19?
Yeah, we believe that, say, last year, if you see, our non-microfinance portfolio grew by about 50%, but our microfinance consciously we had reduced it, and it degrew by about 35%. So overall, we had a 15% growth in AUM last year. This year, our microfinance will grow at around 15-20%. That's what we estimate, while non-microfinance should continue to grow around 50%. So on a combination basis, we expect the overall book to really grow somewhere in the range of 35 to 40%. So that's what we estimate for the current year.
Okay, all right. So we'll leave it on that note. Thanks for joining in. Good luck with all of those plans. That's Equitas talking about the way forward. They have undertaken a hike both in deposit as well as lending rates in the last 1.5 months. Time to now move on and focus on yet another company. Symphony signed an agreement to acquire 95% stake in Climate Technologies. This is Australia's leading manufacturer of cooling and heating appliances. The value of this transaction is about 200 to 220 crore rupees. So let's get chatting with the management to get some more details on this. We have Rupesh Shah, ED of Symphony, now with us. Mr. Shah, thanks for joining in. So is this entirely going to be funded by internal accruals? What kind of a company is this? How does its margins compare with your margins?
Symphony's treasury is in excess of rupees 450 crores. So it can be funded entirely from internal accruals, but for better financial leverage, to ensure that there is a natural hedge, and also to get some treasury margin, we have decided to fund almost 125 crore from debt, which we are raising at about 5.35%, versus here our treasury return in liquid mutual fund or AAA bonds of 7% plus. That's number one. Number two, about remaining amount, that is almost 80 crore is being funded by equity. But at a net level, Symphony will remain as a debt-free company. And based on its business plan, conservatively, we expect that the debt repayment should take place from the cash flows of the target company, that is Climate Technology. As far as the purpose of acquisition is concerned, we feel that it will be immediately value creative. Secondly, the businesses are quite complementary. Value creative in the sense, we understand that the acquisition has happened at a quite reasonable value. It has happened at 7.33 EBITDA multiple of estimated June 18 year. And as far as 18-19 year is concerned, we estimate that EBITDA should be in excess of $8 million. And hence, for 18-19, the acquisition is at just about 5 EBITDA multiple, while in respect of top line, it has registered almost 55 million, and next year expected top line is 65. So in that case, it is just at about 0.70% of the top line. As far as some of the financial ratios are concerned, we expect that in the year one itself, it should generate a return on capital employed of about 20%, while return on net worth in excess of 30%. And this is based on company as it is, where it is. On account of Symphony acquisition, we believe that we can do many other value additions and can bring the synergies, including supply chain, especially sourcing of many components, superior components at quite economical price, and that can further improve its margin down the line. Moreover, the product line of Climate Technology and Symphony are mutually exclusive in the sense from their established distribution network. Symphony's existing residential air coolers can be sold in Australia as well as United States. And in United States, where the estimated market size is approximately $300 million, there is a huge room to grow.
Okay, so it opens up the export market as well for Symphony. You spoke about improving the margins of Climate Technology based on the synergies. So currently, Climate Technology has margins of 10 to 11% based on their last reported numbers, much lower than Symphony's margins of more than 30%. What could be the extent of margin improvement we should foresee?
So as far as operating margin is concerned, that is at a contribution level, its margin is almost 40% vis-a-vis Symphony's operating margin of 50%. At EBITDA level, it's about 12%. Now, exactly how much additional value addition Symphony will make, only time will tell. But based on our past experience of our earlier acquisitions, which were much more challenging, which were absolutely loss-making and Chapter 11 companies, that is IMCO or GSK China. In GSK, in just about 2 years, we have reduced the losses to 25%. And as far as IMCO Mexico is concerned, it is doing extremely well. So we expect that there are many possibilities, and in many respects synergy is possible, but only down the line we can really quantify.
So sir, you have paid 5 times EBITDA. Does that sound fair to you? What kind of ROE can one expect? And also, I mean, from a margin standpoint, is this company going to be adding to your overall total blended margins, or is it net neutral?
So as far as EBITDA multiple is concerned, for 18-19 it is just 5-time multiple. While currently I believe Symphony is traded almost 40-time multiple. As far as sales multiple is concerned, it is less than 0.70. And as far as return on capital employed is concerned, it's going to be more than 20%. So currently our surplus funds generate about 7.5%, and vis-a-vis that, this is going to generate 20%, while return on net worth is expected to be in excess of 30% in the year one itself. And on top of it, whatever further synergies, whatever international market this will open up in Australia as well as in US, and on top of it, their summer is our winter and their winter is our summer. So in a way, it further de-risks the business And overall, based on their past performance, 40% plus Symphony's top line henceforth will be from rest of the world and 60% from about India. So having said that, both are mutually exclusive. As far as domestic business is concerned, it remains as robust as it is, and this is going to be quite incremental.
Okay. Mrs. Shah, since we have you, just a quick question on the entire demand outlook. Has Q1 panned out as per the company's expectations, or has demand been dampened on account of the unseasonal rains that we had in March?
As far as current summer is concerned, as we have communicated earlier, it has not been a good summer for entire cooling industry.
Okay, all right, then we would love to chat more, but completely out of time. Thank you for joining in. Well, with that, we're drawing to a close of Bazaar, leaving the market actually now back in the red. Nifty is now flipped back onto the negative side, about 8 points lower. We take your leave, but lots of trading ideas coming your way up next on Chartbusters.